everybody again. This is John Yeager with Think Business. Have a special episode today. We're going to discuss the PPP, the ERTC, and maybe other acronyms like that as they apply to the QSR and restaurant space. I know there's a lot of interest in this area, and so I'm excited to have a couple of guests on to give us some insight. First, I'll introduce Adam Clayton. Hey, Adam, welcome back.
Hey, John, thanks for having me. My name's Adam Clayton, Chief Financial Officer of Proliant. We're a human capital management company based in Atlanta, Georgia. Offices around the U.S., but primarily focused on the Southeast and have a strong contingent in the QSR world and really kind of blue collar verticals in and of itself. And John, thanks for having me aboard today.
Absolutely. And Tim, welcome to the show. Your first time as a guest, so please introduce yourself and a little background from you.
Thank you, John. I'm Tim Watt. I'm a tax partner at Bennett Thrasher. So I'm a counterpart to John Yeager, and my practice revolves around almost 100% restaurant companies and their owners, all the way from QSR to fine dining, all throughout the U.S.
Excellent. Well, so let's kind of jump into discussion. So, the first question I think is a good background question, and maybe Tim, I'll have you kind of start us off. So, what's the latest on the PPP, the forgiveness, and the taxability issues around all that? What's the latest there, and what can you share, and what do you think's coming?
It's a good question, John. So, maybe a quick recap. So there's the PPP loan program. There's a first draw and second draw program. So I think almost 800 billion in deployed funds. And so with that, most of the first draw loans are coming due, and therefore companies need to either have already applied for forgiveness or should be preparing to apply for forgiveness. And then the second draw loans will be coming due later this year, and the same process will need to be repeated with those. And so that's really, I think, and at a high level where PPP is really most businesses are in the forgiveness process. There's no more funding, though that was closed as of the end of May of this year, and now you're looking at do I have to achieve full forgiveness, and then if I do, is any of that amount taxable? What's that impact to my tax posture? And the good answer to that one is it's not. There is not. It's not taxable. That much has been clarified not only by Congress, but Internal Revenue Service as well. And it's not taxable. And the other part, I guess there's a counterpart to that in tax, is that it's like, well, okay, so I'm not paying tax on this loan forgiveness, but what does that do if I'm a pass-through business for my basis? I have a basis in my ownership. And that also has an impact where it is an increase in basis. So there's this aspect of this is truly, what you would call a grant. It's truly free money for you to use for its applicable purposes, maintaining payroll. And to the extent that you've used all your proceeds to do that, you fulfill your duty, and you will get full forgiveness as long as you fill out the application appropriately per your lender.
So, Adam, what are your thoughts on the PPP and loan forgiveness side of things, following up from what Tim was describing?
Yeah, so kind of to echo Tim's point, PPP seemingly seems to be almost wrapping up right now. We're helping a lot on the reporting side. So just making sure the eligible wage reporting is being, computed correctly. It's honestly, we're getting questions from some lenders. It's got to have the logo of the payroll provider on the top right corner of the screen. So we're having to get crazy with the reporting, but for in large part, that's on the PPP one side. On the round two draws, it's been a little bit interesting in the fact that since there's other incentives in play now, there's a lot of more analysis which is having to be done on what's the most optimal spend of the PPP round two money. So, if you're eligible for retention tax credits, if you got funds from the Revitalization Act, and you have a PPP round two, there's all this interplay of these incentives right now. And I think that's where a lot of the complexity is coming in. And there's a lot of it, there's just no straightforward answer, right? I mean, I think a lot of it depends on just how the spend looks for the company, what their projections look like. You're having to see a lot of CFOs it's a big exercise to go through, but it's just a lot of data points to analyze. And, so we've been helping them out a lot on just sort of education on the credits, education on what payroll spend looks like, education on kind of just working with them on what their business looks like going forward, just from a staffing perspective, just to make sure that they're maximizing the credits effectively.
Gotcha. So, Tim, I want to go back real quick on the PPP side and the forgiveness side. I know we're working with a lot of clients on the forgiveness side. Is there anything that you'd like to kind of point out to the viewers of anything they need to keep an eye on, or things to consider when they're looking at the forgiveness side, or is it fairly straightforward?
I think maybe to Adam's point, there's probably none of it is necessarily straightforward, but I think the one word I would use is just patience, and patience with the application process, patience with the forgiveness application process, and also being patient with pressure from your lenders. I mean, the lenders are pressuring their borrowers to apply for forgiveness, and it is okay to for the loan to become due and start making payments if you are not ready yet. Exercise patience, maximize your forgiveness, and then with amongst all the other kind of COVID relief programs. The Restaurant Revitalization Fund is certainly one of them, and to the extent that you can do that, I think you'll have a greater kind of success in administering all the programs you are involved in.
So patience in the tax and financial analysis and lending process. That's a big ask, I think, sometimes, right?
It's a tremendous ask. I think you certainly have some personalities to deal with, and I think a lot of us are probably more afraid of our bank than we are of a government institution. So those are some things to deal with for sure. So a lot of hard business decisions and some judgments to make.
Absolutely. So Adam, you started talking about some of the other things like ERTC and revitalization credits and those kind of things. Can you give a little bit more info into those? I think our audience probably at the high level knows what those are, but maybe the interplay between them, if that makes more sense.
Sure, and I think the interplay is the toughest part, and that's where probably the most thought process goes into. So a lot of the biggest incentive that we're working through with our clients is the employee retention tax credit, which it's typically designed for smaller employers, and most of the benefit is designed for smaller employers. But technically, the eligibility is defined as you have the first bucket, which I call the kind of the objective measure, which is, do you have a significant decline in your gross receipts? And there's a benchmark period in 19 that you look at compared to what your revenues look like in 21 or 20. And you say, hey, did I have a more than 20% decline in gross receipts as it relates to 21, or did I have a more than 50% decline as it relates to 20? So pretty objective measures involved there. The next one is where we get the most questions, is on the subjective side, right? Which is, did you have a full or partial business disruption due to a government order, right? So questions arise is a tweet from a mayor or a government order? And the answer is probably not. So the IRS has tried to explain as much as they could via frequently asked questions. They've issued a couple notices, which has clarified some points, but obviously, as with any really IRS guidance, it doesn't there's just so many different subjective items out there that they can't just get to them all. So there's a lot of I've seen some providers out there, they're just qualifying everything, which is, hey, if you had an employee that didn't show up to work, that's a business disruption. And I've had other people that are taking the more conservative and right approach, which is, looking through the IRS guidance, making sure that it's appropriate. So a lot of just concern and questions around that group, which are not meeting the objective, but are questioning if they meet the subjective portion of it. But it's just big money involved, right? I mean, that's the biggest problem. I've had calls with operators, which is, this is a $5 million question form or a $6 million question form. And it's and there's no, oh, I can point to this to say you're right or you're wrong. There is a very subjective analysis. So it's been interesting, and it's been just, like I said, maybe a lot of patience involved in that process too.
Tim, I see you're nodding your head. I think there's some agreement you see there, and any guidance you want to provide?
Yeah, no, I mean, it's kind of 100% agreement with Adam. We're seeing the same things. These are, 7-digit, numbers. It is very meaningful. And yeah, the subjective part is difficult. There's a lot of maybe lack of awareness or maybe some misinformation out there with understanding that part. And, our job as professionals is, steering them into the right direction. And, kind of John, as a CPA firm, our job is to, is penalty protection. That's one of the big things is, do we have substantial authority on the position? And some of these, you do get into the territory. Well, it's like, kind of, I don't think so. I don't think you qualify there. And those are difficult conversations.
Yeah, I got one thing to echo what Tim was saying is that maybe one kind of big takeaway for the audience is read your contracts. And there's a lot of providers out there who are not going through that sort of diligence that, Bennett Thrasher would go through, which in terms of the qualification, and they're just saying everything under the sun qualifies. And I think the IRS is, Tim, I think you saw that where they've now extended the statute of limitations because just pertaining to this one credit, because I think people know there's people out there who are taking advantage of it, being egregious with it, and really not being prudent and acting as the credit was supposed to be intended.
Yeah, absolutely 100% agreement there. 5-year statute of limitations is enough to get your attention.
Yeah. Absolutely. That's I appreciate that. That's a great insight for for our viewers. So, what other areas should restaurant owners be thinking about? Whether they're we've talked a lot about PPP and forgiveness. We've talked a little about ERTC. What other areas should they be looking at? Either things that are going on now, or maybe things you guys are seeing that may come down the pike soon. Adam, I'll start with you.
Yeah, so I guess one of them is on the infrastructure deal that's currently going through Congress. So right now that's kind of ratcheting back a little bit on the retention tax credit provision. So really putting a cutoff at the end of Q3 as opposed to the end of the year. So that's definitely one thing to keep on your plate. That's really applicable for really those that are qualifying under the gross receipts test, because a lot of the business disruption, a lot of the government mandates, a lot of them have really subsided greatly since May, June this summer. So definitely something to keep out for. But again, just on really kind of just the math exercise involved with these credits, maybe going to that again, there's so much incentives coming out of Washington and at the state level too, and they're all trying to say, hey, don't double dip on these provisions, right? And so that seems very easy in theory, but I think when they're writing this, that's the intent. They shouldn't have the same dollar twice. But when you go into practice, it's a lot harder than that, right? Because it's just in the payroll world, we're calculating either like work opportunity tax credits for clients is you can't use that same wage for the WOTC credit as you can use it for PPP, or you can't use it for retention tax credit. So there's a lot of math that's involved, and typically we've seen a lot of our clients, and I think people in general, is they have different solutions, different providers for all of those different kind of credit utilization. So imagine working with 3 or 4 different vendors and saying, okay, well, maybe it doesn't make sense for me to take WOTC on those wages and I put them towards this credit. And so not only do you have a math exercise, you almost have a competing vendor exercise, which is one vendor wants to claim as much credits as they can, and the other one's like, well, hold on, no, it makes more sense for them to claim this one. So that's been an interesting exercise just in and of itself.
Absolutely. And Tim, any thoughts there, that things you're seeing?
Yeah, I think mine are maybe a little bit kind of getting away from the kind of credits and incentives for a moment. There's the call it the restaurant industry itself, encompassing all segments thereof. It's going through a lot of movements, a lot of mergers and acquisitions, and so I think kind of my thoughts are if you're in kind of the expansion mode, or you want to expand your business, you want to do acquisitions, now is a great time to do that. there is a lot of there's a lot of liquidity out there to access to capital, whether that's private equity or bank lending, and including there's the SBA has their EIDL loan program, which just recently went up from $500,000 to $2 million. And yes, you're supposed to use that for in your current business for applicable purposes, but cash is fungible. So it is a great opportunity to use that to expand your business. Try to find those better locations for where there's an at-risk lease that you can maybe take over. Buying real estate is probably the last great tax shelter right now, at least, where you might overpay for it, but I think it pays for itself in the short term. And then there's also the part about just what Adam was referring to, just the massive amount of kind of government incentives out there, not on the federal level, but state and local level. Looking for those, these incentivized zones that you can, set up shop and hire people and get a, call it a wage credit for, or property tax abatements, or other investment credits. There's great opportunities for that. And then kind of flipping to the other side, there's the exit strategy. What better time to exit if you were already planning one? I mean, the multiples are sky high. Probably thanks a little bit to inflation, but again, that there's still the access to capital is kind of, there's so much cash out there. People are overpaying, and the capital gain rate right now, or income tax rates in general, are likely going to go up, and that's probably we'll figure that out, what that looks like by the end of the year, hopefully. But what better time to sell? I mean, you kind of have to ask the question is, what does a tax rate increase cost me if I sell later versus today? How much does that EBITDA multiple need to go up to compete with a higher tax rate? And is it even going to go up any higher than it is now? So we're seeing kind of a lot of those questions being kind of answered by, owners that want to exit and those that want to expand. They are kind of hitting those markets pretty hard, keeping the brokers and the dealers very busy.
Yeah, it's an interesting time, with everything that's going on. To have those options in front of you is really good, but obviously it takes the analysis and working with your advisors to come to the right conclusion. So I'm going to wrap it up. This has been a fantastic conversation. Really appreciate you guys hopping on. I want Adam, if you would kind of wrap it up for you and give our viewers an opportunity to know how to get in touch with you if they have follow-up questions.
Awesome. Thanks, John. And thanks for having me on today. That was a great conversation. So again, my name is Adam Clayton with Proliant, Chief Financial Officer here. You can reach me via email at aclayton@proliant.com. That's PROLIANT. Or my phone number is 770-395-1671. So thanks again for having me, John.
Absolutely. And Tim, how about you? I'm sure there's going to be a lot of people that are going to want to follow up with those questions and that you talked about as well.
Yeah, no, as you can say, I'm not, it's kind of hard to get me to be quiet for a moment, but again, yeah, Tim Watt, a tax partner at Bennett Thrasher, working with John, and my email address is tim.watts, that's tim.watt@btcpa.net, and phone number direct is 678-302-1420. Certainly invite any and all questions related to the industry on all topics. Love to hear and chat with anybody.
Very nice. All right, thank you. So that ends today's episode of Think Business. Again, thank you, Adam and Tim, for joining us. Again, I'm John Yeager with Bennett Thrasher, and you can reach me at john.yeager@btcpa.net, or you can find me on social media at John Yeager. Hope everybody has a great day, and until next time, take care.